about to hear my conversation with Dustin Reed, our chief fixed income strategist. We talk all about the reaction in the markets driven by trade, tariffs, changing regimes, as well as get his reaction to the Bank of Canada decision earlier today. I hope you enjoy. This podcast is for informational purposes only. Information relating to investment approaches or individual investments should not be construed as advice or endorsement. Listeners should seek professional advice for their situation. Welcome to Market Exchange, a podcast from Mackenzie Investments. My name is Matthew Schnurr, and I'm back with Dustin Reed, our chief fixed income strategist. Dustin, welcome back.
Hey, Matt. Great to be back with you.
Well, let's start. There's plenty to cover today. We're recording on April 16th at 1:52, just in case things change in the next minute or so, because it feels like we're in that type of environment. But let's start with Bank of Canada. Recent meeting occurred, and I'd love to get your reaction and thoughts on the decision not to cut and just what you took away.
Absolutely. Yeah. So Bank, as you said, had its meeting this morning. Bank opted to leave rates on hold, which leaves the main policy rate at 2.75, 2.75, which is right in the middle of its so-called neutral range of 2.25 to 3.25. The bank had somewhat surprisingly cut back in March. At the previous meeting, on the back of concerns around the tariff story that everybody knows, and maybe a bit worse U.S. economic outlook as a result, obviously, as well as the domestic outlook. And that was not consensus. There was a small majority looking for the bank to not cut, to hold rates at the March meeting. We were outside of consensus on that one and had that one. But today we were looking for a similar kind of playbook, but the bank decided to rotate a little bit more towards the near-term inflation outlook higher. This meeting comes after the April 2nd stuff globally, Tariffs Liberation Day, and a little bit less on the downside growth scenario. Although in the press conference, it looks like Macklem was a little bit more open towards the fact that there was a decent discussion around cutting rates today, but they obviously decided to keep rates on hold. So our out of consensus view this round was not totally accurate, but I do think that the bank probably will cut at least once or twice more this year if the tariff story, the global economic story, particularly the North American economic story, evolves as I expect. And the bank is still doing forecasts. Obviously, it wouldn't be a central bank if it was not. But it is trying to hold forward guidance around the next interest rate move. They've effectively dumped forward rate guidance from earlier in the year. I think that was at the January meeting. So really not opining too much on the next potential move in rates. But today's meeting, the April meeting, is traditionally a forecast meeting for the bank, which it was today. And so the bank did release its monetary policy report, its MPR, and had two main scenarios kind of going forward. Obviously, there are many scenarios that can happen, but broadly speaking, this idea, one scenario is that there's a lot of uncertainty, but the tariffs are relatively low. And then the other scenario is there are significant tariffs and a significant downside risk to economic output. And the bank's kind of running on those as in terms of what kind of scenario analysis it might do going forward. Both scenarios, I would say, although to different degrees, but both scenarios seem to suggest some downside risk to growth, maybe more for the latter than the former, and also some upside risk to inflation, which probably doesn't surprise a lot of people listening to the podcast. Not stagflation per se, but stagflationary tendencies where you have higher inflation and lower growth. But I think the bank is likely to come back later this year, at least once or twice, to probably take rates to 2.5 or even 2.25. Even on kind of what I would call the organic grind in terms of how I think things will play out. Obviously, if there's kind of a left tail downside risk on economics and lower economic growth, then depending on the inflation outlook, I think that we could see the bank move below 2.25%. But that's still a risk case at this point, not necessarily a base case.
Couple of follow-ups on that. The bank was considering tariffs. Are they specifically looking at the Canadian impact on tariffs and what the reciprocal tariffs might look like between Canada and the US, or was it more of a global commentary?
Yes, to your question, they look at the North American aspect and the bilateral, but I think when the bank runs the models through its totem system, it does take into account what kind of the impact for global economic output because it'll be looking at things like global trade, the value of the Canadian dollar, obviously as it trades globally, oil prices, those sorts of things. So it would be a smaller component, but not completely ignored to look at how the global tariffs might be playing. And of course, you have this. And we'll see what happens, obviously. But in terms of the reshuffling, in terms of global trade, is China going to now buy more from Canada? Is Canada going to, trade more with China? Same question, maybe with European Union, either European Union, China, European Union, Canada, and you kind of go around the world. And so the bank would be trying to, as best as it can, try and figure out and model that, which is very challenging when you kind of are moving out of a global regime into a new regime and how those trade flows would work. But yeah, tough things to understand and model, but the bank would definitely be taking that into account.
Maybe last question on Canada before turning to the US, but we have an election coming up later this month. Would you expect the results of that election to either impact the Bank of Canada trajectory or meaningfully change sort of growth domestically?
Well, I think it depends on, a few things. Obviously, where the tariff story stands there, what the makeup of the government is, not necessarily liberal or conservative, but if it's a majority or minority
Right.
based government. And I say that with respect to what a fiscal program or fiscal programs might look like, and that'll be really, I think, what the bank is going to be looking at. If there's for whatever reason, not necessarily my base case, but if there's a big fiscal program that looks to be coming down the path, then that will obviously be part of the bank's calculus in terms of how much accommodation or not it will want to have in the system. So the election counts from that perspective, but in terms of kind of a knee jerk reaction within weeks, again, unless something very odd happens within this 90-day pause that we have around tariffs, although Canada's not really included in that in most regards, it shouldn't be a significant issue. I think I'm trying to remember the last time you and I did this podcast. I think it was before April 2nd. The big surprise, I'm sure we'll talk about tariffs, but the big surprise around April 2nd for many people, particularly sitting here in Canada, is that Canada was not included not only in the reciprocal, but also in just the 10% baseline. And a lot of people had been speculating that there was going to be a big fiscal package here, particularly with the Liberals starting to run away with the polls, and we'll see what happens. But more likely than not, it seems like a majority government. But I think that the non-announcement, as it were, for April the 2nd, probably took the heat off of a big fiscal program, the need for a big fiscal program here domestically, unless something changes materially. So it is important. The election is obviously important, and it's probably, obviously, just sitting here in Toronto again. Probably one of the more consequential elections in my lifetime, and maybe for many people. But I think immediately it's probably not a big deal. It'll be somewhat reactionary depending on what happens out of the U.S.
Fair enough. Well, let's turn to the US. I think you're right. We haven't talked since Liberation Day, April
Yeah,
2nd. Clearly, a lot has happened in the way of tariffs on, off. We have a 90-day reprieve for most countries in the world. I mean, maybe I'll just start with a open-ended question. Just how do you try to navigate all of the news flow and like how do you discount probabilities of where you think things are headed?
it's a good question. It's not easy. I certainly don't have all the answers. I try to have as good an answer as I can. Using our team here and the network that I've been able to help kind of create over the years, which I've been very fortunate to do. These are very difficult things to navigate because there might be a plan, but That plan seems to be changing a little bit, and there's really only maybe one or two or three people that really know what's happening. So it's very difficult to get, as we would call it, get an edge. The way I've looked at it for a while is, rightly or wrongly, I think, and since the fall, I think we've said this probably on a couple of podcasts. I think that Trump and key people around him believe that, well, obviously, this is more obvious now than it would have been 6 months ago, that the U.S. is not being treated fairly from a trade perspective, trade deficit, and you can argue if that's true or not true, and fair or not fair. But that is the view, right? It's
Right.
it's kind of like the central banking, how I talk about it. It's not really what should they be doing; it's what will they do. And then you can kind of put this more on the, for lack of a better term, fiscal side. What should they do versus what will they do? And you kind of put yourself into there. And then the other big underlying tenet here has been, I think, and again, this sounds a lot more obvious now than 6 months ago, but ERS, External Revenue Service, and kind of setting this up, which sounded kind of like a meme back in the day, was actually quite serious, because this administration, again, rightly or wrongly, believes that foreign corporates or foreign consumers should be paying more to the U.S. government, and we should move away from having those revenues generated from domestic sources, for corporate or consumer. So kind of that underlying view, and so that's why I think kind of January talked about this idea of April 1st and this universal tariff, and that was kind of the running thematic for most of Q1, not all of Q1, but most of it. And in many ways that effectively happened. I mean, April 2nd, and this idea that even with the reciprocal tariffs then going on and off, there's this baseline and this
Right.
this revenue this revenue grab. And I think that's very much here to stay. And so that's kind of base case or base working assumption, and then everything else is kind of fungible on top of that, which is obviously a lot more complex than it sounds. But what does it mean for every country, and what does it mean for the trade deals, and what does it mean for each country's fiscal and central bank? And I think we're at a point here where, um, I think the market is very focused on trying to figure out, can this administration do that many trade deals in a relatively short period of time, at least versus historics? And what does that mean? Are we going to be looking at kind of another kick the can down the road scenario in early July? And I think there's obviously some concern around that. I think the market is not completely believing that Trump and his administration will be able to get that done. And you can see that with what's happened in the bond market last couple of weeks. I mean, obviously equities as well speak for themselves, but the bond market reaction, and I would say the FX reaction, US dollar reaction,
Right.
and credit spread reaction has been very, very telling and very important in terms of how I think the market is starting to assess and reprice. The term I like to use a lot right now is recalibrate, just not only global risk sentiment, but also U.S. assets. So, the way I look at it here is, tariffs are with us. The uncertainty is with us. Cross asset vol is probably with us. I think, again, maybe it sounds more obvious now than it would have 3, 4, 6 months ago, but the baseline tariffs of around 10% are generally going to be with us. China is clearly going to be ostracized by the U.S. government, and then everything else. And not to give a throwaway statement, but everything else is very much kind of bespoke, and it will depend on the deal. And I do think that the Japan is literally at the White House right now as we
Right.
speak with a 37-person contingent, and I think that I don't know if I want to say blueprint's probably a little bit strong, but I think that whatever deal or not deal, but whatever deal happens with Japan is going to probably be used as a blueprint or semi blueprint for how a lot of other deals, particularly with larger economies, are going to play out here for the next uh, 2 or 3 months as we move into early July.
Great context. I believe in the answer to your first question, you had referenced regime change in general, and I certainly think that seems like a reasonable explanation of what's happening with the U.S. and the clear pivot
Yeah.
to tariffs and the like. So, one, would you agree with the characterization regime change? And then, I guess, second of all, how far out can you see, or do you have a sense for what this could mean in the sort of medium term?
It is a great question. It might be the question of the day or the year in many ways. So I think cross asset vol is going to trade higher here, and that's a thematic that we've been on for a while, right? We did the Get Sharp podcast with David Wang last summer, and it was a thematic in Q2 for the second half of the year last year, and kind of came and went. Everyone remembers the August long weekend
Right.
pop. And obviously, with Trump coming in, risk of that, and given the tariff story, that's clearly happened. What I think a lot of people probably did not fully appreciate was that there was going to be a pretty significant all the tariff back and forth headlines really was going to cause a significant loss of confidence, not only on the consumer side but also on the business side. And we really saw that start to curtail or start to tail off in the February data as this February data started to roll in, whether it was relatively real time or with a month lag. And that started this idea of, is U.S. growth exceptionalism done? Because people have been trading off of that for a long time, whether that's U.S. equities generally outperforming, U.S. treasuries as a safe haven, U.S. dollar is the global reserve currency of choice, and also kind of on the right side of, depending which how you look at it, but of the dollar smile, and also a bit of a safe haven. Are those things that we hold to be relatively true now not entirely true? What does that mean, and how much, for lack of a better term, how much air needs to come out of the tire on all those
Right.
things? And that's a very tough question to answer, because the regime change or shift or recalibration, as I say, I mean, that's a structural long-term issue that the market is going to start jamming into a relatively short period of time. Hence, equities really, really moving gappy, right?
Yeah.
Treasuries being sold off, so prices lower, yields materially higher, even with equities selling off, and that is generally not how it works. U.S. dollar being sold off materially. Again, don't particularly see that during cases of so-called risk off or negative global risk sentiment. And we know from very early days here, because we're in the early weeks of this, so top of the first inning, bottom of the first inning type stuff. We know from some of the custodian data that a lot of international investors have already started to um, reallocate or pivot away from US dollar assets. And that to me is significant. And that'll be the question, kind of going back to your question of like what happens over the medium term, long term, depending how you define it. But I think we are going to see central banks, global sovereign wealth funds, big pension plans globally start to reallocate away from US dollar assets. And that doesn't mean it goes to zero. I'm
Of
absolutely
course.
not saying that. But what I am saying is that if you were maybe max overweight or significant overweight, you take a bit off, and now you're moderately overweight. And if you were moderately overweight and that's where you were comfortable, maybe you're neutral to like slightly overweight. And if you were neutral for whatever reason, then maybe that goes down a notch to moderately underweight. And obviously, I'm being very vague, broadly speaking. I'm trying to paint a picture of, if you believed a certain regime or way of allocating assets, however, whatever those assets are, particularly in the US, and you kind of had a range of where you wanted to be, that range is probably lower now, because I think people are concerned about the way policy is functioning in the US, or not functioning, depending on how you look at it. And the volatility around U.S. assets, again, that's why I keep saying the same thing, but I think it's really important for our listeners. Cross asset volatility is higher. And when volatility around any asset, but in this particular case, U.S. assets move higher, and you've generally been a part of an investing regime or environment where that volatility, whatever asset class it is, has been, is lower or has been lower, then you have to adjust. You have to adjust your risk model and how much risk you want to have on the table, what we would call VAR or value at risk. And in any VAR model, if your vol has gone up, then just from a mechanics, a mathematics perspective, you just can't have as much risk on the table. You can't have as much money allocated towards the trade, and hence the rotation of potential rotation away from U.S. assets to other parts of the world. I mean, it's a lot more complex than that because where do you go, right? I mean, global
Yeah.
reserve currency, a lot of people say there really isn't another one besides the US, and US equities, Nvidia, and a lot of these very, very strong, growthy type names. I mean, obviously, there are other places in the world you can find that, but US has generally, dominated that. And US fixed income, I mean, obviously, where I sit predominantly, um, generally the safe haven, the safe haven asset of choice if things, really go south. Is that true anymore? Better question is probably how true is it, right? If it was a 9 or a 10 before, is it still a 9 or a 10? And so I think everybody's having this discussion. We're having this discussion. I mean, I'm having it a few different ways. One, I mean, primarily one, obviously on the fixed income team. And how do we deal with that from a duration, and then maybe secondarily a currency perspective, and then maybe third from a credit perspective, and then obviously maybe secondary to all of that is from a global investment committee perspective, not only our main allocation but also kind of the subclasses within fixed income, and obviously the regional breakdown within equities, and there's currency component to that too. So I think if we're having it, no surprise, um, and probably almost everybody is having it. And again, not to repeat, but I think that the probability is that people are going to say, on the margin here, I probably not only do not want to have as much allocated towards the U.S., but I actually cannot because the volatility around the asset classes is higher, and so mathematically, from a risk management perspective, I have to take some off the table.
Great explanation, Dustin. I want to turn to China now, which is clearly in the crosshairs of U.S. trade policy and the back and forth leading to what could be the beginning stages of a fairly major trade war or continuation, depending on how you want to frame it.
Yeah.
Um, what do you think that the impact would be from escalating trade protectionism on both of those countries for the global economy?
It's a great question. I mean, you've got the two largest economies in the world kind of going at it from a trade perspective, which is needless to say not constructive for either economy, nor global growth. We could talk probably an hour or two on this question alone because I think it's really fascinating. I mean, the general view I think is that it is a bit stagflationary, higher prices, lower growth, just on a regular steady run rate going forward. There is an interesting kind of maybe not pushback, but a kind of reverse thought to that on this idea that if China can't sell its goods in the U.S., is it going to, without sounding dramatic, but is it going to close its factories? Is it going to stop production? And maybe an answer to that is, I mean, maybe it slows down a bit, but generally, no. It's going to continue to produce things. It doesn't want to have massive unemployment, so it needs to find another market or other markets for its goods. And if it does that, since the world is relatively, not entirely, but relatively efficient already, does China start? I don't want to say dumping, but selling goods
Yeah,
at
sure.
very, very cheap prices to other regions or other countries, and does that actually push prices down? I think it's an interesting idea and an interesting theory. I'm not sure that it's going to happen, and if it does happen, I don't think it's going to happen right away. So I think the immediacy of it is stagflationary-ish tendencies, in particularly China and the U.S. I do think that, I mean, clearly both would probably like to find an off ramp or a couple off ramps to fix this, but it seems like this environment around the trade war environment between China and the U.S. is going to be with us for a while, and I think you can see it in some of the Chinese data and some of the policymaker decisions and some of the discussions. So by that, I mean, seems to be maybe more than a little bit of a pickup in the last week or so around doing more for the consumer in China via direct, um, direct support. And we just had the Q1 numbers this week for China, a little bit better than expected on the year-over-year numbers. And we saw over the weekend, this past weekend, they do a part of the data series that comes out of China monthly is like credit and financing and those types of figures, kind of liquidity, although not central bank liquidity, but liquidity in the market from the banking perspective. Anyway, there was significant increase in the March data that we got this month, April, around banks injecting the ability for consumers and businesses to borrow, expanding balance sheets. And that to me is a telltale sign that they obviously want to get the economy working a bit hotter, and that's been a thematic for a bit. Nothing new there, but also maybe prepping and having additional capacity for bank balance sheets in order to help not only underpin, but I would say juice the economy. That seems to suggest, I mean, maybe I'm reading too much into it, but it seems to suggest that China's kind of digging in for a long-term battle around tariffs, and that it and or the U.S. It expects it or the U.S. to not necessarily be relenting anytime soon. And then some of the industrial production data and the retail sales data, which was also out this week, was also quite strong. So the data is all of a sudden, quote unquote, taken a pretty big turn for the better after a string of not amazing data for the past little bit. So I think that, again, I could be reading too much into it, but I think that seems to suggest that they are digging in for a while, and we could be in that kind of back and forth tariff story for a bit. I mean, there seems to have been like small off ramps here so far. I think there's been so many. I might have it slightly wrong, but basically, when the U.S. did its most recent move, I think from 125 to 145%, China basically said, "Hey, we're just not going to retaliate anymore." Which was to me a bit of a door ajar. Like, okay, this is kind of the end of it. We're kind of calling it here. It doesn't mean it's going to climb down per se, but maybe the escalation period is over. But obviously, China is also said we're going to limit or restrict exports of rare earths materials, which the U.S. needs for a lot of things and does not produce on its own. And China also said it's not going to buy, you know, Boeing planes or parts, which is kind of the poster corporate, so to speak, for America, right? I've said it a bunch of times, like if I'm the U.S. or Trump administration, like if like you do something X for us, and and we'll sell you Boeing planes. I actually use Boeing as an example. So I think it's probably a little bit more than symbolic that China's doing that, but I do think it's not constructive probably for the near term for global growth. And you've seen a lot of the think tanks pare down, which of course could be wrong, and a lot of the big Wall Street shops and Bay Street shops have also chunked down GDP growth for 25, some for 26, and raised inflation estimates for 25, and not as much for 26 yet. Still a bit of a debate whether it's inflation's transitory or not, a bit of a one-off.
Let's turn to the portfolios, Dustin. As we've referenced, it's obviously a very challenging time to get an edge or think about what's going to happen tomorrow, let alone a month from now. So, how are you positioning the portfolio? What trades do you currently like?
So we still like this spread trade on U.S. and Canadian fixed income, thinking that spread will narrow over time. From a 30-year perspective, which is generally how I look at it, although we have it on kind of two different ways with 10s and 30s. But from a 30-year perspective, we were minus 155 basis points, got to actually, I think in the melee earlier this month, we got to minus 111 basis points, and it's since come back up to around 135, negative 135. But we still like that to move lower. We think that makes, or at least a more compressed spread, which is a better way to say it. Still like that for a bunch of reasons. Canadian supply, some bid for the long end in the U.S. We think that inflation, although need to be careful in the U.S., isn't necessarily going to run away. And regardless, when it's a spread trade, it's less about just how one curve is doing, and obviously how a couple curves are performing. We have still this New Zealand trade where we get a lot of our duration from, or at least a decent amount of our duration from, in some of our portfolios, picking up a fair bit of yield spread over the Canadian kind of benchmark equivalent. We think that the economy is turning a bit there, and that the central bank will continue to be active. And so on the way down, it's still a good place to receive or buy New Zealand fixed income in the 10-year space, and also the compared to Canada anyway, the hedge is relatively inexpensive. EM is similar. We haven't really done a ton. We still have our Indonesia trade from a high yield carry perspective, and we did buy some both some short end and some 10-year M Bono Mexican paper to have a little bit more higher yield capture as Mexico, the Central Bank of Mexico, continues to cut rates into the cycle here, and what's likely to be a bit of a lower growth environment. On the credit side, we've been pretty focused on making sure we've had quality across the board. But just speaking with our lead analyst, actually earlier today, just thinking about, it's been such a significant move in credit spreads, as I'm sure a lot of listeners will know, both
Sure.
on the investment grade side and on the high yield side, that from a kind of a cyclical value play perspective, he was saying that things are trading at levels like down the credit spectrum level that really, in his opinion, shouldn't be trading there. So it's more of a medium term cyclical play. And I won't get into specifics because we haven't done the trades yet. But this idea of things have maybe overcompensated a little bit, and if you still believe medium term cyclical in the underlying fundamental businesses, then from a value perspective, there is value there. And so I think that's something that we'll be looking at more from a credit perspective than from a macro perspective. But the macro, obviously, from a business cycle perspective, does impact that. There's a couple of trades that we're doing. We do have some long yen FX trades on against USD, which have done well, and we've got some FX options, and we also have some FX options on long Canada dollars, so USD CAD lower, Canadian dollar appreciation, and those have done okay as well. Partially on the domestic story for Canada and Japan, but really I think those trades are more about broad US dollar sell-off, kind of going back to where we were earlier in the discussion around kind of the air coming out of the tire around a number of US assets, US dollar included. So that'll be a handful of things that we've got on, or at least thinking about here in the portfolios.
Dustin, thanks so much for walking us through and taking time away from what I'm sure has been a very busy day, week, and coming months, undoubtedly. So thanks again for taking the time.
For sure. Always happy to do it. Thanks for having me.
The content of this podcast, including facts, views, opinions, and recommendations, is not to be used or construed as investment advice and is not an offer or an invitation to buy or sell any security. The content of this podcast should not be relied upon for any purposes, and Mackenzie Financial Corporation is not responsible for any reliance upon it. This podcast includes forward-looking information that reflects our current expectations or forecasts of future events. Forward-looking information is subject to risks, uncertainties, and assumptions that could cause actual results to differ materially from those expressed herein. Our views are subject to change based on market conditions. Commissions, trailing commissions, management fees, and expenses may be associated with mutual fund investments. Please read the fund facts and prospectus before investing. The indicated rates of returns are historical annual compounded total returns, including changes to unit values and reinvestment of all dividends or distributions, and does not take into account sales, redemptions, distribution, or optional charges or income taxes payable by any security holder that would have reduced returns.